Welcome to Discovering the Law. My name is Lucy Rivera. Episodes of this program can be viewed at www.discoveringthelaw.com. Today, we have a very special guest. We have Professor Cornelius Hurley, who is the director of Boston University Center for Finance, Law, and Policy. Professor Hurley, thanks for being with us today.
Lucy, it's great to be here. Thank you for inviting me.
Professor, we would like to learn about the origins of the financial crisis in 2008. Would you please talk to us about that?
Sure, I'd be happy to, but before we get into that, I wonder if I might do a little promotion for my center at Boston University.
Well, why don't you tell us about the Center for...
So a number of years ago, President Brown and I had a line of discussions. This is before the financial crisis of 2008. And even at that time, the financial system was showing signs of stress, and we both agreed that because the financial system is the lifeblood of the economy, that if we started the university over that day, we probably would have had a school or college devoted to finance, law and policy. But since nobody was around to give us $50 million, we decided to set up a center to study that, to do research in that area, and I was honored that he asked me to set it up. Basically what we try to do is to take all parts of the Boston University campus, all 32,000 students and however many faculty that deal with this subject, whether they're in the law school or the business school or the economics department, School of Journalism, Metropolitan College, even the medical school, that are dealing with finance and that are impacted by our financial system, and get them all hanging out on the same corner and doing targeted research in this dynamic area, which as we have our discussion today, I hope I'll convince you is dynamic.
So, Professor...
yes, the financial crisis.
Please tell us about the...
Yeah, in some people's minds, the financial crisis occurred in 2008, 2009, and then ended. In other people's mind, we are still living within that financial crisis era. If you pick up the newspaper today, tomorrow, yesterday, you are going to find scores of articles that are a pure reaction to the financial crisis. What caused it? Well, if we talk to your audience, every person we would talk to would probably have their own explanation of what caused it. Some would say, oh, it was subprime lending, right? Yes. Making home loans to people that probably shouldn't have had them. Oh no, it was the greed of bankers. Oh no, it was the crazy, misunderstood financial instruments that we created. Oh no, it wasn't that. It was our regulatory system that had giant gaps in it. And then some would even say it was something called credit rating agencies that came along and blessed financial instruments, put AAA rating on instruments that shouldn't have been rated AAA, that basically did the homework for banks and other institutional buyers, and they did it in a flawed way. And there are many other causes that we could list. But therein lies the problem. Because there was no one easily identifiable culprit, the reforms that we've enacted have been scattered, complex, all over the lot, and I hope we'll get into evaluating some of those reforms, and maybe we can talk about a particular reform that I think would be effective.
But before we go into the reforms, there is no one single cause for the crisis. However, mostly the well-known too big to fail term has been tossed around.
Right.
Could you tell us the relationship with the financial crisis and that?
That's a term of art. Actually, it's a term that is not defined in any law or textbook. But I think we all, in our bones, kind of know what we mean by a too big to fail bank. And we know it from the experience of 2008, when a small number of banks were bailed out by the taxpayers. And just to put a somewhat finer point on it, because we didn't explain to the public why we were bailing out the banks, and because we came up with a very complex law, DoddFrank, which we'll talk about in greater detail, that unease, that bailout, and we're not talking about a few dollars, we're talking about $1 trillion, unexplained to the American people. A complex law, 2,300 pages, DoddFrank, passed in 2010, 2 years later, not explained well to the American people. I contend, and many others do too, that there is a bright line connection between those events and the existence of the Tea Party today and the dysfunction that we're experiencing in Washington. Now, obviously, Obamacare has something to do with that too, but it's of the same ilk.
So, Professor, just to clarify, what does it mean, too big to fail? Too big to fail
means a financial institution, but it can also be General Motors, a financial institution whose financial well-being, if it is threatened, can take down our financial system, and with our financial system, the economy as well.
And what are the banks that are considered too big to fail that will take down the economy if they go down?
The too big to fail banks are of two types, real and false.
Okay.
The false ones are defined in Dodd-Frank as a financial institution with assets of over $50 billion. There are maybe 37 of those, and they are not, by anybody's reasonable definition, too big to fail.
Which would be which banks?
Oh, that would be a bank like,
Street.
State Street is a unique animal because it's more, it's less bank than it is custodian and critical player.
Okay.
But for the purposes of this discussion, we'll talk about traditional banks.
Yes.
Those of you that may be from Ohio in your audience may be familiar with an odd institution's name called Fifth Third, Huntington, Regions Bank. So those
JP Morgan?
No, not JP Morgan. JP Morgan is a true, bona fide, actual too big to fail bank. Let's talk about the true, actual, bona fide too big to fail banks.
Yes.
They are JP Morgan Chase.
Yes.
They are Wells Fargo. They are Bank of America.
Okay.
They are Citibank. They are Goldman Sachs. They are Morgan Stanley. There is a very, basically the cutoff for being bona fide, actual, indisputably too big to fail is $500 billion in assets. If you're an institution with $500 billion in assets or more, you are indisputably too big to fail.
And Professor, you said there are real banks and then not real banks. What does that mean? Shadow banking.
Yeah, shadow banks. Shadow bank is a term that was coined before the financial crisis. Basically, it connotes financial activities, risk transformation or maturity transformation that goes on, takes place outside of the traditional financial system, unguaranteed by things like the FDIC or unguaranteed by the Fed. Problem. This shadow banking system has existed for years and years. Our regulatory apparatus barely knew it existed prior to the crisis. And trillions of dollars of assets that we thought were outside of the traditional banking system, deposit insurance, Federal Reserve, actually were in the system. They were in what they call off-balance sheet accounts, which in the financial crisis had to be brought back onto the assets onto the books of the traditional banks.
And what are some examples of this shadow banking?
Well, there are three. There's something called money market mutual funds, which was a pure construct to allow mutual funds back in the early 80s collect deposit-like activities at a time when interest rates were very high. There's something some people may have heard of called the repo market, where broker-dealers fund themselves largely by pledging assets, right, in exchange for cash. Maturity transferation, where they get cash, a short-term asset, in exchange for a longer-term asset that they pledge. And then there's it was the repo market that blew up. Bear Stearns, we know about that, that caused the failure of Lehman Brothers, and has not been addressed adequately to this day. Derivatives. Mind-numbingly complex instruments that Warren Buffett called financial instruments of mass destruction. Those were the shadow banking instruments that brought down the likes of AIG, that the taxpayers paid $185 billion to bail out, right? We paid approximately $600 billion to bail out the likes of Bank of America, JP Morgan, and the others that I mentioned.
To subsidize them and make them...
It was in effect a subsidy. It saved them, many of them, from the graveyard.
By buying their shares?
Well, it was originally intended, the law that allowed much of it to take place was originally intended for the Treasury to buy bad assets, what they call toxic assets. But it wound up being not that, but rather tens of billions of dollars of purchases of equity securities, preferred shares, direct infusions of investments into these institutions.
Professor, please talk to us about the Frank-Dodd legislation that was in DoddFrank legislation. That how did it come about? What is it for? And what does it say?
DoddFrank, the overriding purpose of DoddFrank was to eliminate too big to fail. That was the stated goal. Now, it did a lot of other things too, some good. It created something called the Consumer Financial Protection Bureau that Senator Elizabeth Warren from Massachusetts is closely identified with. But that was a side issue. The main purpose was to eliminate this too big to fail phenomenon. And I give a lot of talks around the region and the country, and actually internationally. And I often start by taking an informal poll of the audience, and I ask the audience, how many of you think that the too big to fail problem no longer exists today in 2015 as a result of this 2010 law, the Dodd-Frank law? How many of you think that? And typically the answer is 99+% of the people are convinced that too big to fail is still with us. And then I ask a further question. I said, how many of you think that we are at least on the path, the right path, to eliminating too big to fail, where the taxpayers will no longer be responsible for the obligations of Bank of America and JP Morgan Chase? And still, it's 99%. So the public, and I'm not talking about students, I'm talking about the public, is highly skeptical that too big to fail has been adequately addressed by Dodd-Frank. Are there a lot of things going on in that area? Yes. There are thousands and thousands of pages of regulations. Are some of them good? Yes.
Thousands and thousands of pages of Dodd-Frank.
No, I said thousands. I should have said tens of thousands of pages of new regulations. So Dodd-Frank, for example, requires banks to be more highly capitalized. Well, that's a good thing, but it's a far cry from eliminating Dodd-Frank. Why? Because the number that the regulators choose for the proper capital ratio is made up. It's a negotiated figment of a regulator's imagination. Is it better that they have more capital than the banks did going into the financial crisis? Of course it is. But in terms of our being vulnerable to the failure of Bank of America, for example, many of these institutions are larger than they were before the financial crisis. Many of them are more complex than they were before the financial crisis. And many of them are taking greater risks than they were before the financial crisis.
So does Dodd-Frank fix the problem?
No, no, it doesn't. And it's because of that that I came up with my own solution to the problem.
Great.
That I think is the final solution.
Yes.
Shortly after Lehman Brothers failed in 2008, which was not bailed out, I wrote an article in Reuters that said basically, look, the essence of too big to fail is the attraction that banks have for achieving too big to fail status. Now, what do I mean?
Yes.
If you're a financial institution, one of these half a dozen or 8, that has the taxpayers guaranteeing all of their debts, you are subsidized.
Right, by the FDIC,
By the taxpayers. By the taxpayers, yes, by the FDIC, by the Fed. But bottom line, if you follow the bouncing ball, the bouncing ball ends up in the lap of the taxpayers. It did last time, it always does.
Okay.
So there is a cost benefit that goes with being too big to fail. Large banks get some of their funding from depositors, you and me.
Yes.
But most of their funding comes in the capital markets, where they have to go out and sell debt, right? The capital markets, just like you and I know, just like the 99% in my audience knows, that if they get in trouble, they are going to be bailed out by the taxpayers. What's the result of that? Well, the result is that those institutions that get to borrow at a lower rate because there's no risk premium to their debt.
Okay.
So that therein is a large part of the subsidy. It is that they can fund themselves on the backs of the taxpayers. The closest analogy that I can think of is we're all familiar with Fannie Mae and Freddie Mac.
Which are institutions that lend money for housing.
Well, they buy
loans.
They buy and guarantee loans, but they're private companies.
Right.
They were prior to the crisis. They're in conservatorship now, but prior to the crisis, they were privately held companies.
Yes.
With the implicit guarantee, just like Citigroup, of their debt obligations. So you had this very unseemly circumstance where their debt obligations, all of the risk was socialized. All of the benefit was privatized to the shareholders. That's exactly what's going on with Bank of America, Citi, and these elite banks. They are subsidized by the taxpayer. So here, if you can bear with me for a few minutes, here is my solution.
Well, let's keep the
Sure.
viewers
On the edges of their seats?
Just to let them know the solution. Today we have Professor Con Hurley, who is the director of Boston University Center for Finance, Law and Policy.
Yeah.
And my name is Lucy Rivera. And Professor, please tell us, what is the solution?
The solution is it's not in higher capital. It's not in better liquidity standards. It's not in what they call living wills and all these other complex, crazy things that DoddFrank puts the banks through. Rather, the solution lies in recognizing the incentive that each of these too big to fail banks have to become too big to fail in the first place. That incentive, as I just explained, is the subsidy. Now, that subsidy can be measured. It can be measured. So what the bill that Congressman Capuano has filed does is, and by the way, it's only 2.5 pages. It's not 2,300 pages like
Dodd-Frank.
Yeah, it's 2.5 pages. Check it out. It's called HR 888. 2.5 pages. Put it on your bedside. It says to each of these too big to fail banks, not the other ones, not the community banks, not the credit unions, but just the too big to fail banks, over $500 billion. It says to them, look, every year, a part of your earnings is attributable to the taxpayer's subsidy, you are not entitled to that, okay? We want you, every year, to recognize that amount. It's just an accounting entry. Enter on your balance sheet that amount of your net income or your retained earnings that's attributable to the subsidy. That's all. Simple, right? That's step one.
Okay.
Step two is every year you accrete, you add to that amount. And you don't invade it year by year by dividending it to the shareholders or by giving it as a bonus to Brian Moynihan, the CEO of Bank of America. You can't invade it that way. You have to accrete it year over year. And it's a large amount. What happens? In a short period of years, and I'm talking 3, maybe 5 years, these banks that are now undercapitalized become robustly capitalized. In fact, they become so robustly capitalized that they are potentially too safe to fail because it's all equity. But it won't get to that point. What will happen well before that is shareholders. Shareholders. I'm not talking about bureaucrats in Washington. Shareholders. I'm talking market discipline, which is the altar with which many Republicans worship. Market discipline. Market discipline will cause these institutions to downsize themselves. How do they downsize themselves, and why do they downsize themselves? They downsize themselves by selling subsidiaries, selling assets, spinning off business lines. Some of these complex companies have 3, 4, 5,000 subsidiaries.
Oh, yes, that's right.
Yes. So they divest some of those assets, and when they divest those assets, a pro rata portion of the reserve, the subsidy reserve, goes with what's divested. So there is every market discipline, market incentive for these too big to fail behemoths whose very existence, by definition of the name too big to fail, whose very existence threatens our well-being, threatens our financial system, threatens our economy, threatens your job and my job, and it causes them to downsize to the point where if they become less than $500 billion in assets or no longer too big to fail, then guess what? They don't have to keep this reserve anymore. And the system isn't vulnerable to their failure.
And where is this bill at, Professor Hurley?
The bill, as I said, is called H.R. 888. Congressman Michael Capuano filed it earlier this year. It's been referred to the House Financial Services Committee. But Congressman Capuano is a Democrat, and we have to realize that the House is controlled by the Republican Party. So I'm hopeful that either it will be picked up as the legislative process goes on, or what would be very helpful is if one of the presidential candidates, and it could be a Republican presidential candidate, or it could be Hillary Clinton or Bernie Sanders, who picks it up and says, gee, this is the solution. You know, a lot of legislation has been filed that says, including by Elizabeth Warren, by the way, that says, well, we got to break up the big banks. Well, I agree with that. The big banks have to be made smaller. But just saying break up the big banks is pure rhetoric. You have to have a plan. And it has to be politically realistic. My plan is politically realistic because it's not a tax, which the Republicans would go crazy over. It's not
breaking a bank.
Yeah, it's not a bureaucratic control, which again the Republicans will go crazy over. But it does accomplish the breakup, the downsizing of the big banks. But it does so not according to a bureaucrat's whim, but according to market discipline. You know,
Wonderful, Professor.
Brian Moynihan is going to say, well, I have to sell assets. I want to get the most value for those assets that I can for my shareholders.
Professor, we have run out of time, but this was incredibly interesting. For everybody watching, Professor Con Hurley is the director of Boston University Center for
Finance, Law, and Policy, or the Your Name here. If any of your listeners or viewers have
ideas
or many millions of dollars that they want to invest in our center, their name can go on the Your Name Here Center for Finance, Law, and Policy.
Thank you, Professor. My name is Lucy Rivera. This episode can be viewed at www.discoveringthelaw.com. Thank you for watching.